Before we start, a quick reminder of how this video works. When I move, the video speeds up. When I stop, we learn. So movement is just flow and building. Stopping is where the understanding happens. That's where the marks are. Today we're covering IAS 16, Property, Plant and Equipment. IAS 16 is not a difficult standard, but it's a long one. And if you don't understand the order in which IAS 16 works, it feels like a collection of random rules. Once you understand the order, IAS 16 becomes procedural, and procedural standards are the easiest ones to score marks in. Objective, scope, and the IAS 16 roadmap. IAS 16 sets out the accounting treatment for property, plant, and equipment. The objective of the standard is to prescribe how an entity should recognize, measure, depreciate, revalue, impair, and ultimately de-recognize PPE, also known as property, plant, and equipment. IAS 16 applies to tangible assets that an entity uses in its operations, unless another standard requires or permits a different treatment. For example, assets held under sale fall under IFRS 5, and investment property measured using cost model applies in IAS 16. IAS 16 follows a very clear roadmap. First, we identify whether an item qualifies as PPE. Secondly, we decide whether an item should be recognized. Third, we measure the asset, initially and then subsequently. Within measurement, we deal with the depreciation, the revaluation, and impairment. And finally, we de-recognize the asset and consider presentation and disclosure. If you follow this order, IAS 16 never becomes confusing. Identification. What qualifies as PPE? Property, plant, and equipment are tangible assets. They are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes. In addition, the asset must be expected to be used for more than one accounting period, so essentially more than 1 year. All four elements matter. If an item is not tangible, it's not PPE. If it's not used in its operations, it's not PPE. If it's short term, it's not PPE. Items held for short term are accounted for in IAS 2, which is inventory. Only long-term tangible operational assets fall under or within IAS 16. The recognition of property, plant, and equipment. Once an item qualifies as PPE, the next question is whether it should be recognized. An item of PPE is recognized as an asset only when two criteria are met. First, it must be probable that future economic benefits associated with the assets will flow to the entity. And secondly, the cost of the asset must be measured reliably. If either of these criteria are not met, the item is not recognized as PPE. When recognition is appropriate, all costs initially incurred to acquire or construct the asset are recognized. Spare parts, standby equipment, and servicing equipment require judgment. If they are expected to be used over more than one period, then they are recognized as PPE. If they are expected to be used in the short term, then they're treated as inventory. Initial measurement. What cost really means. At initial recognition, property, plant, and equipment is measured at cost. Cost includes the purchase price, including the import duties and non-refundable taxes, net of trade discounts and rebates. Cost also includes directly attributable costs required to bring the asset to the location and condition necessary for it to operate as intended by management. These include site preparation, delivery, handling, installation, assembly, professional fees, and lastly, testing. In addition, cost includes the initial estimate of dismantling, removal, and site restoration costs. Borrowing costs are capitalized when the asset is a qualifying asset, in accordance with IAS 23. The key principle here is simple. If the cost is necessary to get the asset ready for use, it is included in its costs. Costs excluded and subsequent costs. Not all costs are capitalized. General administrative costs, initial operating losses, abnormal waste, relocation and reorganization costs, and costs incurred after the asset is ready for use are expensed to profit or loss. Day-to-day servicing, such as repairs and maintenance, are also expensed. However, some subsequent costs are capitalized, such as replacement parts and components that provide future economic benefits. Those ones are recognized as PPE. When a component is replaced, the carrying amount of the old component is de-recognized. If major inspections are done, those are capitalized, because without those inspections, the entity cannot continue to obtain economic benefits from the asset. Componentization. IAS 16 requires significant components of PPE to be identified and accounted for separately. This is because different components often have different useful lives and depreciation patterns. On initial recognition, an entity must use judgment to identify significant components and to allocate the cost of the asset to those components. If the cost of a component cannot be determined at initial recognition, the cost of a replacement may be used as an estimate. When a component is replaced, the remaining carrying amount of the old component is de-recognized and the new component is recognized. Subsequent measurement, depreciation, revaluation, and impairment. After recognition, an entity must choose one measurement model for an entire class of assets. Under the cost model, PPE is carried at cost less accumulated depreciation and accumulated impairment loss. Under the revaluation model, PPE is carried at fair value at the date of revaluation less any subsequent depreciation and impairment. Fair value must be measured reliably using IFRS 13. Depreciation is the systemic allocation of depreciable amount of an asset over its useful life. The depreciable amount is the cost less any residual value. Common depreciation methods include the straight line, the diminishing balance, and the units of production. Revaluation increases are recognized in other comprehensive income and are accumulated in equity, unless they reverse a previous decrease recognized in profit or loss. Impairment is dealt with under IAS 36. De-recognition, presentation, and disclosure. An item of PPE is de-recognized when it's disposed of, or when no future economic benefits are expected from its use or disposal. The gain or loss on de-recognition is calculated as proceeds less carrying amount and is recognized in profit or loss. If payment is deferred, the proceeds are measured at present value, with the interest component recognized separately. Finally, IAS 16 requires appropriate presentation on the face of the financial statements and detailed in disclosures in the notes. Now let's bring it back home. If you understand the order of IAS 16, which is to identify, recognize, measure, depreciate, revalue or impair, and de-recognize, then the standard stops being overwhelming. It becomes mechanical, and mechanical standards are where marks are easiest to secure.